Gold stocks got hit. Gold was down 2% on the week. It closed at, let's see, 3,240. I think something like that. Let me take a look. Yeah, 3,241.60. And, I heard a lot of talk. That's it. The bull market's over. Blow off top, right? Finally, it's over, right? It was too speculative. There was no speculation there. Yes, it got a little hot for a few days, and now it's come down. But, it's way above the prior resistance. So it's a massive breakout of the price of gold.
Gold began 2025 with strong momentum, surpassing $3,000 per ounce in March and reaching an all-time high of $3,500.05 on April 22nd. This surge was fueled by escalating U.S. China trade tensions, aggressive tariff policies under President Donald Trump, and a weakening U.S. dollar, prompting investors to seek safe haven assets. Investment demand soared, with global gold ETF inflows increasing by 170% year-over-year in Q1 2025, totaling 552 metric tons, the highest since early 2022. Chinese investors played a significant role in this trend, with inflows into gold ETFs reaching a record 70 tons, $7.4 billion, in April, more than doubling any previous monthly record. Following the peak in late April, gold prices have retreated, dropping to $3,211.53 per ounce on May 1st, the lowest since mid-April. This decline is attributed to easing U.S. China trade tensions, as both nations signaled a willingness to negotiate, reducing the immediate demand for safe haven assets. A stronger U.S. dollar has also made gold more expensive for foreign investors, further contributing to the price decline. Despite short-term volatility, the long-term outlook for gold remains positive. Analysts predict that gold prices will stabilize and continue to rise, supported by strong physical demand and ongoing market volatility. Investors are advised to view the recent dip as a potential buying opportunity amidst persistent uncertainty and stagflation concerns. Peter Schiff, a prominent economist and gold advocate, believes that the recent price drop is a temporary setback in a long-term bull market. He argues that the current economic environment, characterized by persistent inflation and central bank policies, supports a continued rise in gold prices. Schiff emphasizes that the Federal Reserve's inability to effectively combat inflation will lead to further depreciation of the U.S. dollar, making gold an attractive hedge. As we present clips from Peter Schiff's recent video in which he gives a detailed analysis, please share and like this video, subscribe to the channel, and turn on the notifications bell for more videos. We appreciate the support and hope you enjoy the video.
I mentioned that the stock market has recovered pretty much all of its post-Liberation Day losses, but the dollar has barely recovered. I mean, it was up a little bit on the week. The dollar index was up about 0.5%. We managed to finish, I think, slightly above 100. Remember, the low was below 98. So we have had a bounce in the dollar, but it hasn't, come back to where it was or even close prior to Liberation Day. The same thing with Treasury yields, which rose on the week again. The yield on the 10-year Treasury is 4.3. Remember, it was below 4 on Liberation Day. And the 30-year is at 4.8. Remember, the highest we got on those rates was just over 4.5 on the 10-year, 5 on the 30. And it was the 4.5% area. That's what caused Trump to surrender on the reciprocal tariffs with the 90-day pause. But I think that treasuries are headed back down to make new lows, and yields are going to make new highs. So we're going to see what happens. But, the dollar's not out of the woods. The bond market is not out of the woods. And even though the stock market has, in fact, rallied, I don't think it's out of the woods because the damage, is already done. If we call off the trade war, a lot of damage has already been done, and it's too late to undo it because the fact that these tariffs are here now has already impacted the economy, not immediately, but several months from now, when all these goods that we are used to importing don't come in because all the orders were canceled. And you could read all the articles about ships that are arriving half empty now from China, and eventually they won't even bother to show up because there'll be nothing to put in them. All of this is going to have an impact. I mean, right now, remember, a lot of businesses were front running these tariffs. So they still have inventory to sell because they ordered this stuff before the tariffs hit. Now, they're not ordering it now, right? So the economic data that we're getting now hasn't been impacted. And I'm going to go over that again in a bit. But so we haven't really seen the impact. I mean, we initially saw some impact in the stock market and maybe in consumer confidence. But the real economy hasn't really felt the sting of these tariffs. And even if we call them off, it's going to take a long time to restart that. And we're still going to have to go through this air pocket where we just don't have any supply of goods. And that's going to impact GDP. The point I want to reiterate is the reason the markets are likely happy is not that we're going to win the trade war, in that it's just going to end. And all of these negotiations that the Trump administration is, referring to the extent that, these negotiations are actually going on. What we're most likely to win is not a concession from our trading partners, but our own concession. What we're going to win is relief from our own tariffs. That is what we have to gain, right? Nothing that the other countries can do for us will be as good as what we do for ourselves by removing our own tariffs, right? So that's how we win, right? We win by obtaining relief from what we have already done to ourselves. So if Trump wants to claim a big victory, I was really kicking the U.S. economy in the groin. I stopped kicking him. So now, now it's a big victory, right? I mean, he's not going to frame it like that, but that's really where it is, because there's not much that we could really gain in concessions, because as I've said many times, the tariffs that other countries have absolutely nothing to do with our trade deficits that we have with almost every country in the world, whether they have tariffs or not. This is an American problem. It is not a China problem or a Canada problem, a Mexico problem, although we made it a Canada problem by basically influencing the results of their election. I'm actually going to mention that a little bit later on, but that's too bad for Canada. They've got collateral damage in this trade war in the results of their most recent election for prime minister. But anyway, it's that optimism. And I think it's false optimism, because I don't think Trump is going to walk away from this. Even if the tariffs are lower, they're still going to be high and they're still going to be a problem. But we've already basically fired another shot. In addition to what Biden did with the sanctions, we're telling the world, look, this relationship is not going to continue forever. You can't keep selling us stuff and loaning us money. Right? You got to wean yourself off of supporting the United States.
Schiff has consistently criticized the U.S. government's handling of economic data, particularly highlighting the manipulation and delayed revisions of key statistics. He argues that the government often presents overly optimistic economic figures, especially during election cycles, to maintain a favorable public perception. Schiff points to the Department of Labor's announcement of significant downward revisions in non-farm payroll numbers, and suggests that these revisions reveal that previously reported job gains were overstated, leading to misguided market reactions. According to Schiff, the manipulation and delayed correction of economic data can lead investors to make decisions based on inaccurate information. He emphasizes the importance of scrutinizing economic indicators and being cautious of initial reports that may later be revised. Schiff advocates for a more critical approach to interpreting economic data to avoid being misled by potentially manipulated statistics. Let's get back to the video.
The Dow was up 2.5% on the week. NASDAQ 3.6% on the week. Russell 2000 2.8%, and the S&P as well. Gold stocks got hit. Gold was down 2% on the week. It closed at 3,240, I think, something like that. Let me take a look. Yeah, 3,241.60. And I heard a lot of talk. That's it. The bull market's over. Blow off top. Blow off top. Right. Finally, it's over. Right. It was too speculative. There was no speculation there. Yes, it got a little hot for a few days. And now it's come down, but, it's way above the prior resistance. So it's a massive breakout of the price of gold. And it wasn't a bunch of speculators that were buying gold. In fact, the public was selling gold stocks all month, even during the rally. You were getting net outflows out of GDX and GDXJ, and they certainly weren't buying physical gold. I mean, the phones weren't ringing off the hook at Schiff Gold. I mean, it picked up a little bit, but really not much because the public is mainly selling their gold. We have a lot of people, I've talked to other gold companies, people have been calling up to sell their gold because they need the money. And now they can get, a higher price. And so they're making a mistake. They should keep their gold, sell something else because gold's going to go up. But it wasn't a bunch of speculation. But, this was a risk on week. People were thinking, aha, the worst is behind us. It's not going to be as bad as we thought. Yeah, I'm going to buy some risk assets and I don't need a safe haven. And so you got selling in gold. You got buying in tech stocks. Let me get into some of the good news, right, that propelled the market. I'll start today and work backwards. And that was the jobs report. The jobs report that came out today, non-farm payroll for April. Once again, just like we've done for the past couple of years, we had a stronger than expected government jobs report. The expectation was for an increase of 130,000 jobs. We ended up getting 177,000. So a beat, right? We got more jobs. In fact, if you look at the range of expectations, it went from a low of 25,000 to a high of 165,000. The actual number was 177,000. We came in above the high end of estimates. Prior month, of course, was revised down, as was the month before that. So the March number was originally reported at 228,000, and we celebrated that number last month. That was revised down to 185,000. So if you take the revisions from February and March, it's basically a push. We didn't really beat the number, but the headlines, nobody focuses on the revisions. That hasn't changed. I'm looking at all the headlines, and it's all about the April beat. The revisions get buried, lower down in the story. So everybody's going to celebrate this strong jobs report, but it's not really a strong jobs report. It's just another one of these bogus reports that we've been used to getting under the Biden administration. Looking through the jobs, it's service sector, hospitality, healthcare, restaurants, bartenders, stuff like that. Manufacturing lost 1,000 jobs, right? Well, this is supposed to be, a manufacturing revolution. Now, I know, we barely started with the trade war, but again, we are losing manufacturing jobs. We're not gaining manufacturing jobs. We're gaining the same type of jobs that we were supposedly gaining when Biden was president. And in fact, again, the birth-death model of companies, that contributed 393,000 jobs. Now, I'm not sure how that drops down to the bottom line, but that was a big number. That's the biggest number in 2 years. Now, it just doesn't, pass the smell test. That in the month of April, when all this stuff is going on, right? Consumer confidence is plunging, business confidence is plunging, the stock market is plunging, at least the first half, right? Everybody is uncertain about what's going to happen. That all of a sudden, all these people decided now's a great time to start a business and start hiring. Do you really think? I think more people were worried that they were going to have to shut their business down during the month of April than were like ready to open up a new business and go on a hiring spree. So, all these numbers, they never make any sense to me. They come from the government, and I just don't believe government numbers.
What we're witnessing isn't just a story about gold. It's a window into how deep economic undercurrents, political maneuvers, and institutional strategies shape global markets. From the dramatic rally earlier this year to the recent pullback, it's clear that gold remains a powerful barometer for uncertainty, whether that's geopolitical tension, inflationary policy, or eroding trust in fiat currencies. The sharp rise to over $3,500 an ounce wasn't accidental. It was the result of real-world stress, renewed U.S. China hostilities, a faltering dollar, and investors scrambling for financial shelter. But just as quickly, the market recalibrated. Diplomatic shifts and dollar strength cooled that rally for now. Yet if you listen closely to analysts like Schiff, you'll realize that these dips are more than just market noise. They are strategic moments, opportunities for those with a long-term perspective. Schiff's take reminds us to look past the headlines and scrutinize the narratives behind the numbers. Whether it's inflated job reports or conveniently timed economic revisions, we're often handed a version of the story that serves a broader agenda. And if that's the case, then your best hedge might not just be gold, it's also discernment. The larger question isn't whether gold will go up tomorrow. It's what these patterns tell us about where the global economy is heading. If inflation remains sticky, if central banks continue to prop up fragile systems, and if data manipulation continues to cloud economic reality, then gold isn't just another commodity. It's a statement, a hedge against deception and decline. So, as we wrap up, here's the key. Don't let short-term price action distract you from the long-term fundamentals. Volatility is part of the ride, but knowledge, timing, and strategy are what separate the shaken from the strong. If this video helped clarify the bigger picture, or challenged how you think about the gold market and the global economy, give it a thumbs up to support independent analysis. Share it with friends, investors, and anyone who's trying to make sense of what's really happening. And don't forget to subscribe. This channel is committed to bringing you expert insights, unfiltered commentary, and the kind of deep dives the mainstream won't touch. Tap the notification bell so you never miss an update, and as always, keep asking questions, keep thinking critically, and above all, follow the real money.